Hello, my name is Ian Berger. I am a Senior Community Development Manager with Synovus Bank. Synovus, the Bank of Here, began operations in the year 1888 and currently maintains over 300 locations across the Southeast United States. Through Here Matters, our community outreach program, we express our commitment to our communities. Here Matters focuses Synovus's volunteer and financial contributions in the areas of education, needs-based opportunities, and health and wellness. I'm proud to represent Synovus today to share the FDIC Money Smart module with you all, titled Bank on It, which is a Banking 101 module. So let's get started. So our objectives for today are to identify the major types of insured financial institutions, to identify 5 reasons to use a bank, to describe the steps involved in opening and maintaining a bank account, to describe 2 types of deposit accounts, to identify additional bank services that come with deposit accounts, and to describe the main functions of the bank, customer service representative, teller, loan officer, and branch manager. So what do banks do? Well, banks, they're businesses that offer a safe place to keep money. They are also called financial institutions, and they offer many financial services. So why do you or should you keep your money in a bank? Some reasons might include safety. Money is safe from theft, loss, and fire. Convenience. You can get money quickly and easily. Using direct deposit, for example, saves you time and allows you quicker access to your money. Funds that are electronically deposited in your account are available sooner than if you deposited a check. We'll talk more about direct deposit later. Also, you can use an ATM or automated teller machine to get fast access to your money. Most ATMs are available 24 hours a day, 7 days a week. You can also use your bank's ATM or debit card to make purchases instead of using cash. Cost. Using a bank is probably cheaper than using other businesses, such as check cashing services to cash your check or pay bills. Security. The Federal Deposit Insurance Corporation insures deposits up to the maximum amount allowed by law. This means that the FDIC will return customers money up to $250,000 per depositor per insured bank based on the current standard maximum deposit insurance amount if a bank closes and cannot give its customers their money. Financial future. Building a relationship with a bank establishes a record of paying bills, can help you save money, and is necessary for getting a loan. So during this discussion, we talked about why you should keep your money in a financial institution. Now let's talk about the different types of financial institutions or banks. There are 2 major types of insured depository financial institutions. Banks and thrifts are financial institutions that operate under federal and state laws and regulations. Banks and thrifts make loans, pay checks, accept deposits, and provide other financial services. Credit unions are nonprofit financial institutions owned by people who have something in common. Credit unions offer many of the same services as banks and thrifts. You have to become a member of the credit union in order to keep your money there. You can tell if the FDIC insures a bank by the displayed FDIC logo. Most credit unions are insured by the National Credit Union Administration, or NCUA. The deposit insurance rules are the same at NCUA-insured credit unions as they are at FDIC-insured banks. The FDIC has an online tool called the Electronic Deposit Insurance Estimator. You can calculate the insurance coverage of your account at each FDIC-insured institution online at www.myfdicinsurance.gov. So opening and maintaining a bank account. You can open your account with any of these institutions, make deposits and withdrawals through your accounts, record interest and fees, and keep track of your balance. But what would you need in order to establish an account? Well, you need account verification. Basically, providing your identity by providing the bank with your name, address, date of birth, social security number or ITIN, or state or government issued ID. So a couple of banking terms that we're going to be talking about, we'll cover right now. First one, deposits. When you open a bank account, you put money into your account. Anytime you put money into your account, it is called a deposit. Whenever you add money to your account, you must fill out a deposit slip. A deposit slip tells the bank how much money you are adding to your account. Depending on what you deposit, cash, a payroll check, or a check drawn on an out-of-state bank, you may not have immediate use of your funds. The bank must first make sure there are funds at the originating bank, which is the bank of the person who wrote the check, in order to cover your check. You should ask the bank when you can use the money that you deposited. Also, even though the bank gives you access to the funds you deposited, it does not mean that the check cleared the other bank. If the check you deposited bounces, the bank will deduct from your account the funds it made available from the check. Second term that we use is withdrawal. When you make a withdrawal, you take money out of your bank account. You do this when you write a check, give a teller a withdrawal slip, or use an ATM. A withdrawal slip looks similar to a deposit slip, except you use it to take money out of rather than add money to your account. You always need to know how much is in your account so that you do not withdraw more money than you have. If you overdraw your checking account, that means you spent more money than you had available in the account. You will be charged a fee, and we'll talk about these fees later. If you take $20 out of the envelope, which we are not going to be doing right now, balance. The balance is the amount of money you have in your bank account. Your balance will change whenever you make a deposit or a withdrawal. Remember to record all of those in your check register so that you will always know your balance. Fees. Financial institutions may charge you fees for different services, including a monthly maintenance fee to keep your account open, a penalty fee if you misuse your account, such as what we were talking about, an overdraft fee when you withdraw or spend more money than the amount in your account, or a non-sufficient funds fee if you write a check that the bank returns unpaid because you did not have enough money in your account. Overdraft programs. Well, many financial institutions actually offer options in the event you overdraw your account, where you spend more money than you actually have. You can avoid the merchant's return check fee, but you still have to pay the financial institution an overdraft fee for each item. Be sure to look carefully at the fees associated with this service, as the fees can be very costly. When you first open the account, the bank will ask how it should handle ATM and point-of-sale debit card transactions that could potentially overdraw your account. By default, you are automatically opted out. That means these transactions that would overdraw your account would be declined and you would not be charged a fee. But if you opt into an overdraft program, the bank will charge a fee to cover transactions. These fees could be costly, as I mentioned before, perhaps $30 or more per instance. The decision you make does not apply to other types of overdraft transactions, including checks or automatic ACH bill payments through online bill pay or recurring charge bills to a debit card. Your bank may offer other low-cost options than fee-based overdraft programs, such as linking your savings account to your checking account to cover overdrafts. Remember that with fee-based overdraft programs, unlike an overdraft line of credit, there is no guarantee that your bank will cover your checks. ATM withdrawals and debit card or other electronic transactions that overdraw your account. Deposits and non-deposit accounts. Bank accounts that allow you to add money to the account are called deposit accounts. Checking and savings accounts are two examples of deposit products. Checking accounts they allow you to pay bills and buy goods with the money that you have deposited. When you write a check, use an ATM or debit card or bank online, the financial institution takes the money from your account and pays it to the designated person or business. The financial institution makes a monthly record of the deposits and withdrawals made available to you either by mail or online. This is called a bank statement. It is a good idea to compare the rules of the different accounts. For example, banks might require you to have a certain balance in order to open an account to earn interest or to avoid fees. This is usually called a minimum balance. So a bank versus a check cashing service. Even though banks may charge monthly fees, it is much cheaper to use a deposit account in a bank than a check cashing service. Say maybe you cashed 4 checks a month and you pay $5, a $5 charge each time you cashed a check. That means you would pay $20 a month, or 4 times $5, or $240 a year in order to cash your checks. Now you want to consider opening a checking account. The bank charges $5 for a monthly fee, which includes 8 free checks per month and free use of the ATM. And ordering a box of checks of 100 checks could cost you around $18. Well, when comparing banks to check cashing services, other benefits also include financial institutions provide the convenience of internet banking with access to your accounts and information 24 hours a day, 7 days a week. Also, using a bank account responsibly can help you establish a positive banking relationship, which may be helpful if you apply for a loan in the future. For example, when buying a car, buying a home, you do not have to worry about cash being lost or stolen with working with a bank. And then you can also easily save money for the future. So these are benefits you would not gain from a check cashing services. Next up is savings accounts. A savings account is a safe place for you to save money. You generally will be paid interest on the money in your savings account, and you generally cannot write checks on a savings account. You can often open a savings account with a few dollars, but you might pay a monthly fee if the balance is below a certain amount. You can keep track of your account balance by reviewing the account statement. Interest. One of the advantages of having a deposit account is the interest you earn. Interest is a percentage of your balance that the bank pays you for keeping your money at that bank if the account pays interest. Most savings accounts do pay interest. It is less common for checking accounts to pay interest, but some do. Now for non-deposit accounts. Many banks also offer non-deposit accounts or products that are not insured by the FDIC. Stocks, bonds, and mutual funds are examples of non-deposit investment products. These carry some level of risk, meaning that you could lose some or all of the money that you invest in these products. Bank personnel should provide a written explanation that these products are not insured by the FDIC and they may lose value. It is important to understand these products and services before you buy them. You can find out more about non-deposit products through your bank. ATMs and debit cards. When you open an account, you will probably be given the option to have an ATM card or a debit card. Both types of cards give you access to your account funds when you need them. An ATM card allows you to make deposits to and withdrawals from checking and savings accounts. You can usually check your account balance, print statements, and transfer funds between accounts. Some ATM cards can even be used in stores that accept ATM cards in your bank's network. This type of card works like a debit card, but it is not widely available. A debit card is also known as a check card, usually displays a MasterCard or Visa logo. It has all the functions of an ATM card, plus it allows you to pay for goods and services at locations that accept MasterCard or Visa credit cards. It really looks like a credit card, but it's not. Your purchases are immediately withdrawn from your account. When you use a debit card to make a purchase, the retailer may ask you to choose whether to process the transaction as a debit transaction, where you input your personal identification number, or a credit transaction, where you sign a receipt in place of entering your PIN. Either way, expect the amount of the purchase to be debited from your checking account immediately. Check with your bank to find out whether there are any fees or incentives for credit transactions versus debit transactions. Another kind of card that can be confused with ATM or debit cards is a store valued or prepaid card. Stored valued cards often have a logo of one of the major payment systems, such as American Express, Discover, MasterCard, or Visa on the card. These braided cards can be used at any merchant or ATM that accepts cards issued through their respective network to pay for goods and services. These cards do not link to your bank account. Therefore, money must be loaded onto these cards, and the value on the card goes down with each purchase. Common types of stored value cards include general purpose cards purchased from retailers. Some come with a set value, while others require you to load or add money to the card after obtaining it. Gift cards purchased in fixed amounts. Unlike most other stored valued cards, these often can only be redeemed for purchase from particular stores or restaurants, and sometimes they are not reloadable. Other types of store value cards include payroll cards used by an employer to pay wages instead of giving you a paper check. Payroll cards are different from other types of store value cards because you do not need to purchase them or pay activation fees since your employer provides the card. Government disbursement cards are another example, and they are provided by government agencies to pay benefits such as unemployment benefits or Social Securities. So some other additional banking services that we want to discuss. First, direct deposit. With direct deposit, your paycheck or benefit check is electronically transferred and directly deposited into your account. The amount of money is immediately available. Some banks will waive monthly fees for accounts if direct deposit is used. Money orders. A money order is similar to a check. It is used to pay bills or make purchases when cash is not accepted. Many businesses sell money orders for a fee, so just try and shop around for the best price if you're going to use a money order. Telephone and online banking. Well, telephone banking allows you to conduct the following transactions over the phone: check account balances, transfer money between accounts, obtain account history such as most recent deposit or withdrawals, stop payment on a check, obtain information on branch hours or other information, and report a lost, stolen, or damaged card. And online banking allows you to be able to access your checking account from a computer. Most banks provide the service for free, while others charge a fee. When you open your checking account, make sure to ask your bank what online services are provided. ATMs, as we've talked about, it's a kiosk or terminal where you can deposit, withdraw, or transfer money from one account to another 24 hours a day. Money transfers. A wire transfer is a form of money transfer from one bank to another. Most United States banks can send money to international banks in addition to sending to domestic banks. Debit cards, as we were just mentioning. A debit card is a plastic card, sometimes called a check card. The debit card usually has a MasterCard or Visa logo and a magnetic strip on the back. The card is tied to your checking account and allows you to pay for goods and services at stores and other businesses that accept MasterCard, Visa, and other credit cards. Store value or prepaid cards, as we talked about, come in several varieties that enable you to pay for goods and services. Some cards may be purchased with a value of nothing, and you can add a desired amount. Others may be purchased with a set value, such as $25 or $50. Generally, you can reload money to and increase the value of the card so you can continue to make purchases. Loans are described as money you borrow from a bank with a written promise to pay it back later. Banks charge you fees and interest on loans. Interest is the money you pay to borrow money, and it is added to the total amount you must pay back. You could talk to the customer service representative for more information about loans offered by your bank. Remittance is a special type or specific type of money transfer that goes to a bank or a person in another country. So privacy notices and opting out. Privacy notices explain how financial institutions and companies handle and share your personal financial information. They explain what information can be collected and how you can possibly limit your information from being shared with others. Privacy notices also explain how your personal financial information is protected. You'll receive an initial privacy notice when you open an account, and then every year thereafter. Federal law requires financial institutions to keep your financial information private. The general public does not have access to your personal financial information. Federal privacy laws give you the right to stop or opt out of some sharing of your personal financial information. So how do you opt out? Well, if you prefer to limit the promotions you receive, or if you do not want marketers and others to have your personal financial information, you must first review the privacy notice to determine whether the company shares information with others, and if so, ask how you can opt out. And then second, tell the credit reporting agencies not to share your information with lenders and insurers who use the information to decide whether to send you unsolicited offers or credit or of credit or insurance. You can also opt out of receiving pre-screened offers by calling 1-888-567-8688, which also is 1-888-5-OPT-OUT, or you can visit the website www.optoutprescreen.com. If you opt out, you limit the extent to which the company can provide you your personal financial information to non-affiliates or groups outside the company. You cannot opt out and completely stop the flow of all of your personal financial information, however. The law permits financial companies to share certain information about you without giving you the right to opt out. Among other things, your financial company can provide to non-affiliates things like information about you to firms that help promote and market the company's own products and products offered under a joint agreement between two financial companies. Also, records of your transactions, including your loan payments and credit card or debit card purchases to firms that provide data processing and mailing services for your company, and information about you in response to a court order, or your payment history on loans and credit cards to credit reporting agencies. Identity theft. There's only one of you. DNA analysis can even prove it scientifically. Even so, with enough information about you, a crafty criminal may be able to steal personal information, such as your social security number, date of birth, or credit card numbers, and use your identity to commit fraud or other crimes. Identity theft is a serious problem. Here's why. Despite the efforts of law enforcement, identity theft is becoming more sophisticated and the number of new victims is growing. If the crime is not detected early, you may face months or years cleaning up the damage to your reputation and credit rating. You may even lose out on loans, jobs, and other opportunities. So common forms of identity theft. Phishing and farming are common forms of identity theft. Phishing is when criminals send out unsolicited emails that appear to be from a legitimate source, perhaps your bank, school, well-known merchants, your internet service provider, or even a trusted government agency such as the FDIC, or they attempt to trick you into divulging personal information. Farming is similar to email phishing as follows. Criminals seek to obtain personal or private information by making fake websites appear legitimate. Your browser will even show that you are at the correct website. This makes farming more difficult to detect than phishing. Also, be careful of skimming. This is when criminals steal credit or debit card numbers by using a special storage device when processing your card. Online shopping security. Some people think that online shopping is the best way to shop. Others do not trust it because they are afraid that credit card numbers or other information will be stolen. Here are a couple of tips to help you do business safely online. But first, make sure the internet site is secure before you use your credit card or enter personal information. Most web browsers will have a symbol, which looks like a padlock most of the times, to identify whether the site is secure. And two, when shopping online, deal with reputable merchants and be wary of unbelievably low prices. If you are uncertain about an online merchant, check with the Better Business Bureau online, which you can go to www.bbbonline.com. You can also search online for complaints about the business. Identity theft tips. Criminals target young people like you, even if you are too young to have a checking account or credit card. They can use your name, address, and social security number to open accounts. While we do not want to scare you, we do want to help you protect yourself from identity theft. So here are some ways that you can, here's some things that you can do in order to avoid identity theft. Protect your social security number, credit or debit card numbers, PINs, passwords, or any other confidential information, and never give them out in response to an unsolicited email, text message, or phone call, regardless of who the source supposedly is. Ignore online friend invitations from people you do not know, because they may be covers for fraud artists. Also, protect your computer. For example, install a free or low-cost firewall to stop intruders from gaining a remote access to your personal computer. For practical tips to help you guard against internet fraud, secure your computer, and protect your personal information, you can visit www.onguardonline.gov. You also want to guard your mail, both your outgoing mail by depositing letters in locked mailboxes or at the post office, and your incoming mail. Pick up your mail as soon as possible or use a locked mailbox. You also want to keep your financial trash clean. Shred old bank statements or other documents containing personal information before throwing them away. Before selling, donating, or disposing of a PC, use special software to completely erase files that contain financial records, tax records, and other personal information. Beware of offers that seem too good to be true. Also, be alert to signs that require immediate attention. These include bills that do not arrive as expected, unexpected credit cards or bank statements, and calls or letters about purchases you did not make. And lastly, review your bank statements, bills, and credit report for suspicious activity. Monitor your bank statements each month and contact your financial institution immediately if you notice something suspicious, such as a missing payment or an unauthorized withdrawal. So, did someone steal your information? No matter how carefully you protect yourself online, if your wallet or purse is stolen or someone obtains your personal information, you may become a victim of identity theft. Here's what to do if you lose your wallet or think you are a victim of identity theft. First, file a report with the police as soon as possible. Keep a copy of the report in case your bank or insurance company needs proof of the crime. Second, contact your bank as soon as possible. You may have to close your account, cancel your ATM or debit card, open a new account, checking and or savings, and request a new ATM or debit card with a new number and password. Third, place a fraud alert on your credit report by calling any of the major credit reporting agencies. Equifax is at 1-800-525-6285. TransUnion is at 1-800-680-7289. Or Experian, which is at 1-888-397-3742. And fourth, contact the major check verification companies to request that they notify all stores that use their database to not accept your lost checks. You can also ask your bank to notify the check verification service with which it does business. Two of the check verification companies that accept reports of check fraud directly from consumers are Telecheck and Certegy. For more information, you can also visit the Federal Trade Commission at www.ftc.gov/ID theft. Financial institutions have various employees to help you with different banking services. Understanding their roles helps you know who you should talk to when you go to the bank. While the exact job title of these employees varies from bank to bank, the job duties are very similar. Some key bank employees to be familiar with are the customer service representative, the teller, the loan officer, and the branch manager. A customer service representative will usually help you open your account, explain services, answer general questions, refer you to a person who can help you if they are unable to, and they can provide written information explaining the bank's products and benefits of those products. A bank teller will usually deposit your money for you. They'll cash your checks, they'll answer questions, and they will refer you to the person who can help you with other bank services. A loan officer will usually take applications for loans offered at the bank. They'll answer questions, provide written information explaining loan products, and they will help you fill out a loan application. And then a branch manager will usually supervise all the bank operations that take place at that branch, and they will help fix the problem that other employees are unable to solve. Here are some key points to remember. Ask for help if you do not know who to talk to at a bank. Secondly, ask questions until you are clear on all the information. Third, do not sign anything that you do not understand. And last, ask for written information to take home to review. So congratulations. You have completed the Bank On module. You learned about types of insured financial institutions, basic banking terms, opening and maintaining a bank account, differences between banks and check cashing services, types of accounts, types of banking services, bank employees and their jobs, and that concludes our Money Smart Bank On It module. Thank you for watching. If you have any questions, on the screen you will see my contact information. Please do not hesitate to reach out to me with any questions or comments you may have. Once again, on behalf of Synovus, thank you.